Hello and welcome to The Resilient Investor with me, David Stevenson. In these podcasts, we try and talk through the basics of investing for all investors, from very beginners all the way through to advanced. And we're going to talk this week about a topic that I think is probably one of the most important topics that investors sort of tend to skate over, which is the importance of dividends and from holding equities or investing in shares. If you look at the academic textbooks, which academics love to print with great regularity, you tend to find statistics that say that over long periods of time, 10, 20, 30, 40 years, dividends paid out by companies, usually on a regular basis, are a large component of total returns. So you make money from investing in a share, and then you make money from the dividends that those shares pay out, and then you make money from the dividend reinvestment that you get from those shares. And when we think about dividend-based investing, it's quite often used another term called equity income investing, same kind of thing. You think of markets where they pay out a big dividend, places like, I suppose, Germany, to a less degree the UK. Most people don't tend to think of North America because you tend to think of that's a growth market. But that's wrong, actually. And we're going to talk a bit about that now with Dean Orrico, who is the manager of the Middlefield Canadian Income Trust, which is a UK-listed investment trust, which invests in North American income-orientated equities. And Dean's with me now. Dean, welcome. You're calling in from Canada, I think Toronto, sunny Toronto.
Sunny Toronto. Not typical for this time of year, but we'll take it. Feels this global warming thing is certainly agreeing with me.
Absolutely. Rest of the world will end in devastation, but Canada and the UK will be all right.
That's right.
Now, Dean, I gave that kind of preamble because, again, as I said, most people when they think of North America, they think of growth stocks, don't they? They think of things like tech stocks. They think about the Magnificent Seven, and they think I'm going to make a lot of money by investing in a share, and then I'm going to basically watch that share price go up because the multiple the market's willing to pay, if you're Nvidia, for instance, will go up all the time because your earnings are going up all the time. But there is another way of looking at investing, isn't there, over the long term? And that's that power of dividends compounding. And you can get that in North America. That's the amazing thing. Admittedly, probably more Canada, I'm going to guess. But you can get that in North America. So let's just go back to basics first. Do dividends really matter as an element of total returns from investing in the world's most liquid region, which is North America? By liquid, we mean big markets, lots of companies, lots of things to invest in, quite tight bid-offer spreads, lots of shares outstanding. Do dividends matter in North America?
They absolutely do. So you touched on a few things at the top, David, where we talked about what the textbooks say, but the textbooks really reflect reality. And as a general point, when you look back over the last 20, 30, 40, 50 years, investing in not only dividend paying stocks, but companies that have a history of growing their dividends, they actually generate better total returns, either in absolute or even on a risk adjusted basis relative to equities that don't pay a dividend. Now, a lot of people, especially people who are newer to the market, i.e. maybe somewhat younger, have a hard time appreciating that point because, we had this decade from 2010 to 2020, which was a decade highlighted by effectively zero interest rates. And during periods like that, growth stocks, and many growth stocks are technology oriented, did very, very well because, when you talk about the duration of an asset, how long it actually pays out its cash flows, long duration assets like technology companies, i.e. growth companies, whose cash flows are further out in the future, get discounted back at a very low or zero interest rate, which grows their overall value in present dollars today. So in very simple terms, that's why growth stocks did very, very well during this period of 2010 to 2020, which then caused many investors to say, I've got no interest in dividends. I want to own growth. And that was a very unique period. And I would argue that really since the pandemic, we've hit an inflection where we're going to see a more normalized economic backdrop which is highlighted by inflation and hence interest rates being higher than what they were during that period of 2010 to 2020. And as a result, we think dividends are coming back into focus. What was a headwind during that decade, I think now becomes a tailwind for dividend-focused investors.
And I just want to pick up on a couple of points there. The first one is, you said progressive, growing a dividend over time. And there's this term you sometimes hear, which is kind of progressive dividend stocks. And that doesn't mean that they're all very left-wing and wander around on market. It means that they, as you say, they increase their dividend year in, year out. And they go to great lengths. And actually, ironically, it's very true for investment trusts. Because investment trusts, because they can conserve their income, can build up reserves, can carry on paying their dividends and increasing them regularly. So that's a particular thing for investment trusts. But also, I just want to, you mentioned effectively what I think is an important point, which a lot of people fail to understand, is that we have a kind of myopia, which is that we think that what happened in the last 10 or 20 years, which frankly most of us is most of what we can remember, because we can't remember anything from 40, 30 years ago. We think that what happened in the last 10 or 20 years is bound to happen in the next 10 or 20 years. And in fact, what happens is that you have these kind of regime shifts where the kind of big economics, the big picture changes. And that matters. So there's a guy called Andrew Lapthorne, who's an analyst at Soc Gen, Société Générale, the big French investment bank. And he's looked at, like other people, decade by decade returns from total returns of investing. And in some decades, dividends can be not just the biggest, but by far the biggest. Something like 60, 70, 80% of total returns in some decades can come from dividend investing because, as you said, sometimes you move from kind of one environment, which is low interest rates, to another environment, which is high interest rates, high inflation. So that regime shift can happen. And you reckon we're at that inflection point. Okay. But why North America? Because again, I go back to North American part. When I think of North America, first I think of America, the USA, the United States of America, and then I think of growth stocks. And then there is another country out there called Canada. But are there equity income dividend stocks in North America?
There certainly are, and you're right. You know, in many ways, perception is reality, and the perception is that the U.S. and North America as a whole is a very growth-oriented market. But you know, as you alluded at the top, you know, you've got a very small subset of companies that are really driving the returns of the market, and last year was a perfect example. If you in fact excluded the Magnificent Eight, now it's the Magnificent Seven, maybe it's the Core Five, whatever you want to call it. But in 2023, if you just excluded the returns from that subset of companies, the rest of the market was relatively flat. So that's really been driving the market as it did in that 2010 to 2020 period. And don't get me wrong, many of those companies within that subset are wonderful companies with, I think, really durable competitive advantages. But below the surface, i.e. the S&P 493, if you will, or a vast majority of the Canadian market, tends to be a bit more mature, less growth focused, and hence it makes sense for a number of these businesses to actually pay out excess cash flow. And that really is what we do here at Middlefield. We try to identify those businesses that we think have the potential to not only pay a high level of dividend, but to do it sustainably and to grow it over time. And there are a large number of businesses that we think have done that. For example, in our Middlefield Canadian Income Trust, the dividend growth rate for the 5-year period ending in 2023 was about 8% per annum. Oh, right. And as a result, we've been able to increase our dividend to investors. We increased it in January of 23. We increased it again in January of this year. And, you know, the plan is, and the board's intention is to continue to increase it over time as well, because we're basically just passing on to investors the dividend growth that we're receiving in the portfolio. And we think that as a result of a slightly different economic backdrop, this regime change, as you refer to it, we think is now taking hold. And outside of that 5 or 6 core businesses that are very growth-oriented, technology-focused, which I would add, David, I think over time will become more mature and be...
Well, they are. Dean, I mean, look at Meta. I mean, Meta has just started paying a dividend.
I would argue today, David, that Google should be starting to pay a dividend. Like, we've actually added Google We've added to it in some of our portfolios recently because we think later this year it will be paying a dividend.
Yeah, because they generate so much cash.
Yeah, because it's so
absolutely.
mature. There's only so much use for that cash. And I think one of the reasons why they're putting more and more of it into AI, because they can't go out and make acquisitions because the FTC, Federal Trade Commission in the US, won't allow it. So in a sense, they're becoming mature businesses, i.e. like staples, technology staples, some people call them, that as a result, they're going to be paying out more dividends over time as well.
Just a couple of quick things also before we go and talk a bit about what's in your portfolio. Just a distinction. Are you focused on dividends? Because there's another thing out there which a lot of people don't realize called buybacks. And so let's just say you've got Acme Corporation generating lots and lots of cash flow, doing really, really well, very profitable, decides to hand money back to the shareholders. It could pay a dividend, which it could pay annually, semi-annually, whatever, quarterly, depends on who it is, what it is. But they could also buy back shares. And we've heard a lot in the past that American companies quite often like doing buybacks rather than dividends. And there's lots of tax complexity there, isn't there? Because American taxes are different than UK taxes and blah, blah, blah. There's lots of detail that we don't have to go into. But are you only focused on the dividend payers or are you focused on the dividend and buyback? Because if you add up the dividend and the buyback in America, this is, I think, something most people don't know about. The dividend, the payout number for the American market is quite high, actually, because there's a lot of buybacks and there is actually quite a bit of dividends. What's your view on that?
It's an excellent point. And in a sense, if I can buy a stock that primarily, from our perspective, pays out a high and growing dividend and supplements that with a buyback, just telling you they've got too much cash than they have uses, then to me that really is the ideal situation. So you've got a buyback yield plus the dividend yield, which in some cases, David, can be in the low double digits, i.e. 10 to 12%, which is really very attractive. And that puts aside any capital appreciation. So you can see how powerful the return profile is just from that buyback yield and the dividend yield. Then when you take it together with potential growth in the stock over time, because some of these companies actually, I think, can get a re-rating. Because the one thing that's happening right now, and especially over the last 18 months, is that many investors are sitting in large cash balances, earning 5 and 6%. In Canada, we call them guaranteed investment certificates. In the US, they're certificates of deposits or money market funds, whatever the case may be. I think the re-rating in a lot of these equity income focused companies is really on the come here, because over time, we think rates will come down. They're not going to go down to where they were during 2010 to 2020, but they'll be lower than they are today. And I think investors will come off the sidelines. And what are they going to do? They're going to go into, we think, equity income vehicles that pay them high and growing levels of dividends because they still need income.
Just one more question before we talk about what's in your portfolio. People might be worried that if you've got a mature company churning out lots of cash, it's gone X growth, is the term that a lot of kind of financial professionals use. So it's basically boring, and it's not going anywhere. And let's be honest, the UK market's full of those companies. Is that always the case?
It's not always the case. I.e., do you mean is it X growth? Is it just basically a mature business? No, there are a number of them that effectively are just in a harvesting stage. But maybe the best example is the oil and gas companies. So in the oil and gas area, we know this has really been a bad word up until the war in Eastern Europe, when everybody was focused on renewables for the last decade. People realized, well, we actually do need fossil fuels. And Canada has, a very robust and sophisticated oil and gas business. And as a result of Russia's invasion in Ukraine, people realized, well, in fact, we're not ready to transition totally to renewables. This is going to play out over decades. We actually need baseload power from fossil fuels, from natural gas. So it's brought some favor back into that sector. But what happened during this period from 2015 to say 2020, our oil and gas businesses really got religion. And they basically said, we are going to prioritize investor returns, i.e., we're not going to just put money back into the ground into drilling activities with very modest growth prospects. We're going to make sure investors get a good return by way of increasing our dividend through specials or regular dividend plus a buyback. But we're still going to be able to grow our production in a much more measured way. So there's a good example of a company that not only is paying a high dividend yield, has a buyback yield, but is also growing their overall net asset value. So you can actually have both. Companies that are paying high dividends are not necessarily low or no growth businesses. They still generate growth, but maybe not at the level that you're going to see out of a Meta or a Google or an Nvidia in the extreme.
Let's just talk a bit about what you can invest in then. Now, your portfolio is mostly Canadian, am I right?
Correct.
But there's some American stocks in there. And when I last looked at it, there was a sort of mix of interesting sectors. There's themes going on. There's kind of financials, i.e. banks. And banks, when they're allowed to by the regulators, pay out a good dividend. They're not always allowed to. And in the UK, they have varying periods where they've basically been told they can't.
Right.
They've got to make sure they've got a good capital base. You've got energy stocks. We'll talk through some of these. You've got infrastructure stocks, which is very interesting, isn't it? Maybe we'll talk a bit about that. And then you've got real estate investment trusts, or REITs as they're called. What's the mix? So, and they, by the way, all of those could be true for US as well as Canada.
Correct.
So again, you're about 95% Canadian, 5% American. But you said that varies, doesn't it?
It does.
Some years it might be more American stocks. So is that a fair characterization of where you find a lot of equity income at the moment?
Sure. So you're right that the geographic mix could vary over time. And in fact, we can be up to 40% US. So in other words, we always have to be a minimum 60% Canada. And as you mentioned today, we're about 95% Canada, 5% US. So I think that's telling you where we're seeing, number one, better value.
Okay.
Number two, high dividends. So the Canadian market generally pays out higher levels of income than the US market does. So outside of technology, even in the REIT sector, we get higher yields out of Canadian REITs than we do out of US REITs. And in fact, we've got Canadian REITs trading at a discount relative to US REITs. So in my view, that is almost a no-brainer, right, David?
Yeah.
I can get a higher yield with a lower valuation out of Canada than the US. That's why I'm generally focused on the Canadian market. So that could change over time. And then in fact, the US weighting is really designed to give me exposure to areas that I can't get in the Canadian market. So Canadian market tends to be, not unlike the UK, a bit more concentrated. So from time to time, I've actually had some technology weighting in the portfolio because there are some technology companies that actually pay good dividends. For a while, up until it's run over the last 12 to 18 months, Microsoft was a core holding in my fund because it paid a 3 to 4% yield. No longer the case because the stock has moved up so much. Broadcom for many years had been a core holding in our fund because it pays a high level of dividend, but it's in the technology area. So healthcare, we really don't have a developed public healthcare sector in Canada, whereas in the US, we can get exposure to some biopharma businesses that actually have some pretty healthy yield. In the UK, you've got companies like AstraZeneca with pretty healthy yields. So given that we don't have those types of businesses in the Canadian market, that's where we'd look to the US to get that exposure. Having said all that, where we think we've got the best risk reward, ensuring that we're continuing to invest in dividend paying and dividend growing companies, is largely in the Canadian market.
So let's look at some of those pillars I talked about, those sectors. You've already mentioned oil and gas. Canada's got a big oil and gas sector. Banks. Now, that's an interesting one, isn't it? Because UK investors have got big exposure to banks. It hasn't really helped them out very much over the last few years. They've been underperforming. How about the Canadian banks? Whenever I look down the list of Canadian banks, they always seem to doing much better than UK banks. What about the Canadian banks?
Yeah, so our Canadian banking sector, I think, is very unique. And maybe the best way to describe that is that during the global financial crisis of 08-09, when you saw the financial sector basically implode in the US and banks went out of business, a number of them cut or suspended dividends, we didn't see any of that happen in the Canadian sector. In fact, our Canadian banks maintained their dividends right throughout that period, and valuations actually stayed relatively stable. Fast forward to the global pandemic of 2020, 2021, you had UK and European banks basically suspend, eliminate dividends altogether. Canadian banks, again, didn't cut dividends during that period. And in fact, our Canadian banks, David, have not reduced their dividends, put aside suspension. They haven't reduced the dividends, not even a cut, since the Second World War. That shows you how stable they are. They generally run with higher capital ratios, higher return on equity. Last year we did a more comprehensive analysis of our Canadian banks. ROEs here are anywhere between 12 and 17%. The average European bank is closer to 5 or 6%. So there is a real robust profit margin here that really gives them the ability to withstand shocks to the system, which do happen from time to time. Last year at this time, we were having problems in the regional banking sector in the US. We didn't see any issues in Canada. So we really have 6 banks that are very well capitalized, that pay healthy levels of dividends. Those dividends tend to increase every year on the order of 3, 5, 6%. We've got them in a weighting in the portfolio of about 26, 27%. Our benchmark is 31 or 32%. So we're fairly close to the benchmark. But at the end of the day, we're not at the benchmark weight or over for our banking weighting, because we still think there are some issues in other parts of their business. We think their loan book is fine because the economies continue to be quite healthy. The consumer is quite healthy. But where you're seeing some lagging profits in capital markets activity, so there's not a lot of M&A activity or financings going on. And our Canadian banks have fairly robust capital markets divisions. And then the other leg to the stool is the wealth management business. And as I mentioned earlier, with many investors still sitting in cash in the U.S., I think the number is close to $6 or $7 trillion sitting in cash. Clearly the wealth management operation of a bank, whether in Canada or the U.S., does a lot better if that money's coming back into the market and that's generating fee income. That's going to happen over time as interest rates start nudging lower over the course of 24 and 25. But clearly that's been a lagging sector. So having said that, those businesses in the financial sector are doing quite well. The growth, I think, is limited until interest rates start coming down and you start seeing more activity in capital markets and in wealth.
Let's finish off with infrastructure, because again, when we talk, going back to the very beginning, when people talk about equity income or getting money from dividends, in certainly the last 5 or 10 years, a lot of money's gone to infrastructure-like assets. And a lot of UK investors don't really realize, but in North America, you've got a huge listed infrastructure sector, which is different than the UK, because in the UK, it's kind of like PFI, PPP, public partnership things, that kind of stuff, roads, schools, and there is some of that in North America. But there's a huge energy infrastructure sector as well, in particularly Canada, actually, but as well in the US as well. And that's also a generator of income. And how's that done over the last few years?
It's actually held in quite well. So you're right. Our infrastructure market, again, is quite unique. And that's why, we think it represents a good diversifier for UK investors, because, we've got, significant exposure to pipelines, whether it's carrying oil or natural gas gathering and infrastructure pipelines and processing centers that are very toll-like in nature. So if I have a pipeline, and maybe the best example that we use because it's a large weighting is Enbridge, which is, a major...
And that's Enbridge, huge player.
Yeah, huge player, $100 billion plus market cap business, just made a major acquisition in the US in the natural gas infrastructure sector, about an $18 billion acquisition, which is going to be closing this year. And for its pipelines or its gas business, the capacity in that infrastructure is sold to producers of oil or gas. And the producer is either utilizing that capacity or not, but paying for it regardless. So it's a very predictable and reliable revenue stream. And hence, these businesses tend to trade at yields of 5, 6, 7%. And when they're making acquisitions on an accretive basis, like Enbridge has over time, you'll start to see some growth in net asset value as well. So they tend to be more stable. You don't get significant growth, but they're very reliable dividend payers, and that dividend tends to grow, as I say, 3 to 5% per annum.
Yeah, and for listeners, you run into something called MLPs in America,
Correct.
which is called Master Limited Partnerships. And they're a bit like real estate investment trusts. It's like you own an asset, you rent the asset out, as Dean says, you pick up a rental income, effectively a lease income. And then as long as you pay out all of that income to the investors, you basically, that's tax-free. Obviously, the investor then has to pay tax on their
you
own
eliminate
account.
the double taxation. There's no tax at the entity level, just at the investor level.
Absolutely. And in America, that's a huge market.
It is.
I mean,
very
actually, if you talk to private investors in America, I would say they're probably massively invested in three things: Magnificent Seven, MLPs, and they have a separate sector, completely different story, not for this podcast, called municipal bonds.
Correct.
Which in North America is a huge area. So I just want to conclude. So Dean, the moral of the story then is that if you're looking for diversification in a portfolio, and most portfolios are very US tech growth orientated at the moment because they've just done so well. Yeah. I suppose your message is think about income, think about equity income, think about more mature cash generative companies and how they fit into a slightly more defensive profile. Would that be right?
That would be right. And what I'd add to it, which I think, again, makes this Canadian story more appealing, is that, we're a country of roughly 40 million people. We have the lowest level of housing per capita of any country in the G7, and we have the highest level of immigration of any country in the G7. And people think Canada of this kind of major, massive landmass, but the reality is 80% of Canadians live in urban centers, and in fact, 50% live in our 6 largest cities. And as you get more immigration, that's where people settle. It's really in those 6 cities. So that's creating even more demand for real estate. And that's one of the reasons why we've got a significant real estate exposure in our fund, because the supply-demand imbalance is so significant, really putting much more weight on growing rents over time, which we're going to benefit from in our portfolio.
Yeah, and just 2 very useless facts. I've been to Toronto a few times. Apparently, I read somewhere that something like 80% of Canadian population lives in 30 or 40 miles of the American border. And final useless fact, for having visited a vineyard in Niagara, apparently the Niagara area has got the same latitude as parts of northern Italy.
That's correct.
Which is why you've actually got good vineyards.
We've got some really good wines here in the Niagara region. Correct.
Absolutely. Can I ice wines, Canadian ice wines? All listeners get Canadian ice wines.
They're very.
Dean, thank you very much for talking to me about the importance of equity income. I hope you've enjoyed this episode of The Resilient Investor. Please join us again next time. Thank you, Dean.
Thank you.